Hello everybody. In this session we are talking about liquidity ratios. Liquidity ratios are a class of financial metrics used to determine a debtor's ability to pay off current debt obligation without raising external capital. Liquidity ratios measure a company's ability to pay debt obligation and its margin of safety through the calculation of metrics including the current ratio, quick ratio, and operating cash flow ratio. And then we move to the types of liquidity ratios. The first type, current ratio. The current ratio is the simplest liquidity ratio to calculate and interpret, so anyone can easily find the current assets and current liabilities line items on a company's balance sheet. Divide current assets by current liabilities and you will arrive at the current ratio. And then the second type, cash ratio. The cash ratio takes the test of liquidity even further. This ratio only considers a company's most liquid assets. They are the assets that are most readily available to a company to pay short-term obligations. In terms of how strict the tests of liquidity are, you can view the current ratio, quick ratio, and cash ratio as easy, medium, and hard. And then the third type, quick ratio. The quick ratio is a stricter test of liquidity than the current ratio. Both are similar in the sense that current assets is the numerator and current liabilities is the denominator. However, the quick ratio only considers certain current assets. It considers more liquid assets such as cash, accounts receivables, and marketable securities. It leaves out current assets such as inventory and prepaid expenses because the two are less liquid. So, the quick ratio is more of a true test of a company's ability to cover its short-term obligations. And then we move to the importance of liquidity ratio. There are some of the importance of liquidity ratios. The first, it helps understand the availability of cash in a company, which determines the short-term financial position of the company. A higher number is indicative of a sound financial position, while lower numbers show signs of financial distress. And then the second, it helps in organizing the company's working capital requirements by studying the levels of cash or liquid assets available at a certain time. And then the third, It also shows how efficiently the company is able to convert inventories into cash. It determines the way a company operates in the market. And then how to improve liquidity. The first step, use accounting software to speed up invoicing. The right software makes sending invoices and receiving payments much easier and more efficient. This leads to better cash flow too. And then the second, consider refinancing. You may be better off consolidating expensive short-term lending into lower interest loans, or you may need extra loans during times of growth. And then the third, improve your accounts receivable by offering discounts or other incentives for early payments. Also, give and send automated reminders so payments don't slip through the cracks. And then fourth, increase sales through expanding your customer base or introducing new products or services without increasing your operating costs. And then fifth, smarten up your accounts payable by negotiating favorable payment terms with suppliers and finding the most cost-effective suppliers possible. Use extended payment terms where it makes sense, but pay on time to avoid late fees and unnecessary financing costs. Cut all non-essential or discretionary spending. And then we move interpreting the liquidity ratio. Its interpretation depends a lot on the type of sector and the company's activity. However, the optimal values of the liquidity ratio are between 1.5 and 2. The first, liquidity ratio less than 1. In that case, it is considered that there is a negative working capital, and this indicates that the company has liquidity problems and therefore complications in facing short-term debts. And then the second, liquidity ratio greater than 1. In that case, the current assets are more significant than the current liabilities, meaning there are no liquidity problems and the company can meet all its payments without problems. However, if it is much greater than 1, it would be necessary to analyze if the company has excess resources and is not making a profit. And then liquidity ratios in small business context. Liquidity ratios hold particular importance for small businesses, which often operate with tighter cash flows and limited access to credit compared to larger corporations. For small businesses, maintaining a healthy liquidity ratio is crucial for ensuring operational stability and financial flexibility. A higher liquidity ratio generally indicates that a small business has enough liquid assets to cover its short-term liabilities, which is vital for sustaining operations, especially in times of financial uncertainty or slow business period. I think it is enough for this session. Thanks for watching, and don't forget give this channel with your like, comment, subscribe and share. Thank you.